Thank you for joining me. I'm Alex, and I would like to do an analysis of Peloton today because I like these new stocks that kind of have potential, but I don't know where it's going, and I kind of want to see if they're worth it, even with a lot of goodwill. So what they do is novelty fitness, basically exercise bikes that allow you to have a trainer and have other people kind of like on a screen in front of you. And I think that is both their great advantage and their great downfall, because technology moves so fast that, having the tiny screen, it's going to get old very fast. So generally exercise bikes last for like years or decades, and here you have something that might get outdated fairly soon, and also you need a subscription, and if the company fails, that's not a great thing. So current price $35, which gives them a market cap of $9.9 billion. They don't pay a dividend, and I don't expect that to happen anytime soon. I would assume that they spend all their money into expanding and kind of getting their sales going as fast as possible right now. I don't think they're going to pay a dividend within the next decade, but it's hard to project after that. Current revenue $915 million, current earnings negative $195 million, which is down from negative $47 million, and a current PE of negative 40-ish. Total assets $865 million, total liability is $462 million, which is actually going decently, I would assume. Decrease of liabilities is always a good thing. Total stockholders' equity of $403 million, which is up from negative almost $400 million. So things are certainly going in the right direction, and in terms of revenue, growing at 100% and growing the previous year at 100%, obviously very good signs. Earnings, negative $195 million, going from negative $47 million, obviously a very bad thing. However, they're fairly small numbers, and I would expect them to be able to turn a profit fairly quickly if they so chose. I would expect them to kind of want to make a loss every year, just to have the business expand as fast as possible and then monetize later. So as far as the whole risk factors goes, number one, no one buys ridiculously expensive exercise bikes in a recession. So if people are fearful for their jobs and their money, their retirement, the whole planning to buy exercise bikes and spending all the money on workout equipment kind of goes down quickly. So I would not think that this is a very recession-proof business, and I would assume that they're trying their best to get their numbers in order before a recession hits, because it's hard for them to kind of survive at the current levels through a recession. I don't think that they would have a problem, at least initially, in raising more money to kind of stay afloat until the recession goes away, but not sure what happens after that. Also very hard to project. Now, what I have a problem with is a market cap of $9.9 billion and a revenue of $915 million. So their price to sales ratio is over 10, which means even if 100% of their revenue was earnings, their PE wouldn't be great. I mean, it would be all right, but it would not be too great. So for them to have a reasonable PE ratio, they would have to at least double their revenue a couple more times and then have a 25% net income ratio. So don't really see that happening anytime soon, but I don't think they're that far away from that. Again, outside factors might influence that somewhat, but So to summarize that somewhat, I think that this is a very risky stock because I don't think they're in safe waters yet. I don't think the price to sales ratio of 10 really makes sense right now, and the revenue growth is slowing somewhat right now. Their year ends in June, and the holiday season, I assume, and especially the new year, with everyone making predictions about going to the gym every day. So obviously that doesn't mean much, but growth is slowing somewhat, and that's kind of a really bad thing for a major growth stock. So not safe principle. Growth slightly slowing, which is a problem for me, and the earnings not great. Not terrible, but not great. They can sustain their growth with the total, with the balance sheet and total stockholders' equity right now of 2 years, which isn't much. So to sum that all up, I think that for a dividend and a value investor, you're definitely out. But for a growth investor, depending on how you feel about the sector as a whole and this company in particular, I think it might make sense to have a very tiny speculative investment, because it might go somewhere, and it might go somewhere fairly quickly. However, I think it's very speculative, and you might lose your whole investment because it might also go downhill very quickly. So if you're not too risk averse, then I think it might make sense to, again, very tiny position. But for me, it's definitely not a buy right now. So I'd be more inclined to wait and see where the earnings go, and if the revenue growth is sustainable for now. I think that they could be growing revenue at 100% for years to come, but it doesn't look right now like they are. And if that is slowing down, that's definitely not a buy for me. So that's it from me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.